Hello everyone, welcome back to Just Invest Today. And in today's video, we're talking about value investing and if it's a dead art at this point, because if you're realizing what I'm realizing in the market, we have a lot of these companies just not re-rating, even if their earnings are growing 10-15%, they just get cheaper, cheaper, and cheaper. And David Einhorn actually put out a video talking about this, and it just kind of shocked my mind and kind of re-evaluated what I'm doing in the market. Because the times of just putting your money into a company and just hoping it re-rates or it gets back to higher multiples because their earnings are growing, that's just not how it's working in this market. You have companies that are beating expectations or beating their earnings growth that a lot of people have for the company, but the company just gets cheaper. It goes to a 9 times PE ratio, goes to an 8, goes to a 7, goes to a 6, even though the company keeps earning more money and more money. So what is happening? So in the market right now, you have to realize it's not like what it was back in the day where you just buy a company. If the company beats expectations, if it keeps growing its earnings, individuals or hedge funds or long only funds, whatever it is, they're going to put their money into that company because it's beating expectations, it's growing. So you have like a multiple increase in the next 2 or 3 years, whatever it is. But that's not what's happening in the market. You're buying companies, for example, at 10 PE with their earnings increasing, but the earnings increasing doesn't re-rate the company. It just goes down to a 9 multiple, an 8 multiple, a 7 multiple. So that's what's happening in the market. And you have to realize that that's happening because the institutions are not doing what they were doing before. Looking at companies, looking at the undervaluation, doing like the backhanded fundamental evaluation on companies as true value investors. That's not what's happening in the market right now. Everything is about algorithms, just putting your money into index funds. You're just buying the best companies like Google, Microsoft, Tesla, etc. Buying sectors like energy, or they're going all defensive. So that's what's happening in the market. You're not doing that backhanded fundamental analysis anymore. So you have to realize what's happening in the market. So how David Einhorn is switching his strategy is he's buying these companies at very cheap multiples, 5 times earnings, 4 times earnings, 3 times earnings. And when you find companies at those multiples, you want those companies to buy back their stock. So when you have a company buying back their stock at those cheap multiples, eventually it's just gonna buy out all their shares because they just keep increasing their buybacks, increasing their buybacks, increasing their buybacks over and over again. So that's what we're gonna have to look for, because that's gonna finally re-rate these companies that just keep declining and declining and declining, no matter the earnings growth of these companies. Why do you think Mohnish Pabrai bought these 2 cheap coal companies? Because they're selling below a 5 PE, plus they're buying back a lot of their stock, plus they're gonna be earning more than the whole market cap very soon because they have these solid contracts going forward. Mohnish Pabrai basically explains this to you. He hasn't seen this before in a long, long time. This is what the market is giving us at this point. David Einhorn is buying the same companies like Mohnish Pabrai. They are both seeing the same thing in the market right now. Let's hear from Mohnish Pabrai in his own words.
The hundreds, thousands maybe of investments you've done in your career. What's been the most memorable? Doesn't have to be the best, doesn't have to be the worst, but just the one that pops in your head as the most memorable investment for you.
The thing is that what I have always found interesting is the anomalies. So for example, I remember in about, I think it was like 2004 or so. In 2004, there's a steel company based in Canada called IPSCO. IPSCO had no debt. It had $15 a share in cash, and it had a given guidance that the next 2 years' earnings were going to be $15 a share each for the next 2 years. So there was $30 of earnings coming in. The stock was at 42. So I'm saying, okay. And the reason they gave the guidance was they used to make these tubular steel pipes where they had contracts with these pipelines where they want to deliver, the pipelines had basically given them purchase orders. And so they were going to deliver these pipes and the cash flows were guaranteed. It's not like they were giving guidance based on future sales to be done. These were sales that were already done. So I said, okay, I don't know what will happen after 2 years. But I know that after 2 years, there'll be $45 of cash on the balance sheet, no debt. And the stock price currently is 42. I said, I just want to see what the stock price is 2 years from now. I want to see what Mr. Market does with this. And I just bought it based on that notion, right? And a year later, the company announces that we have 1 more year of visibility. And we'll have another $15 a share in earnings for 1 more year. And now the stock is at about 70 or 80. it's gone up a bit. Okay. And I'm thinking about, well, it's a steel company, it will go to zero, whatever. It's a very cyclical business. And then it starts drifting close to 90, and I'm thinking of, taking it off. Like I said, the double in 15 months is really good. Let's move on. And then I wake up one morning and the stock's at 157. And some Swedish company offered to buy them at 160. And about 5 minutes after that, I unloaded the stock. I said, we don't need to wait for the last $3. We're done. Recently, the two stocks I found in the US, which I got very excited about, are like that. I never thought I'd find that again, where it's this kind of an anomaly where the guaranteed cash flows are exceeding the market cap and all of that.
Mohnish Pabrai is already up 30% on these picks so quickly because the market is re-rating these stocks because they're understanding how cheap it is and how much buybacks they're doing. So this is what we gotta do in the market at this point. We gotta find these cheap companies at cheap PEs and then wait for these companies to buy back their stock. So you can kind of do this strategy. On top of this strategy, you still can do your wide moat strategy of buying companies with crazy strong fundamentals, with wide moats that are cheap valuations, that are growing its earnings. But you have to realize also other spectrum of what's happening in the market. And look what happened with Mohnish Pabrai's new buys after he discovered this theory of what's happening in the market. David Einhorn is literally doing the same thing. He bought AMR around $164. Look what's happened. Holy, 58%. And he probably bought it cheaper because this was actually before Q2. As well as console, he probably bought it around $60. Probably bought it around $67, $66, or even a little bit cheaper. And look where it's been, 67% since he bought it. And this was happening with these companies. They're selling at a cheap PE, they're buying back a lot of stock, and they have their cash flows almost guaranteed. So that's what you're seeing in the market. That's what's happening. Look at David Einhorn's second biggest holding as well, Console Energy. So they're literally doing that same playbook. So you can see David Einhorn is literally doing the same strategy as Mohnish Pabrai, and he's been buying these companies at these cheap multiples for a long time. So guys, tell me what you think about this video, what's happening in the market, if you're going to switch your strategy or you're just going to add this strategy in your investment toolbox. Guys, like and subscribe to my channel. Peace.